Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning beverage, whether that's coffee or tea, and let's enjoy this episode.
If you look at a 30-year fixed mortgage rate of 6.4% right now, you're probably thinking, wow, this market is just incredibly harsh.
Oh, absolutely. It feels brutal.
Right. But, the most surprising thing about the 2026 housing market isn't even that rates are high. It's the fact that 6.4% is actually the heavily cushioned version of reality.
Yeah, the artificially protected version.
Exactly. Like, if it weren't for this massive hidden safety net operating completely behind the scenes, we would be looking at a housing market in an absolute unmitigated freefall right now.
It is a sobering reality to consider. We tend to assume the numbers we see advertised by our local banks just represent the natural state of the free market, right?
Right, like that's just the price of doing business.
Exactly. But in this specific environment, there are massive structural forces actively intervening to keep those numbers from going much, much higher.
And to you, listening to this right now, welcome. We're doing a custom-tailored deep dive today specifically for you. Our goal is to help you become the absolute most well-informed person in the room regarding this bizarre, totally stuck housing market we find ourselves in.
It's definitely stuck.
Yeah. And we have a grounding source today that is going to help us really tear this entire situation apart, like from the macroeconomics all the way down to the for sale signs in your local neighborhood.
It's a fantastic source.
It is. It's a June 2026 report from Zillow Research, written by Kara Ang, and it does not pull any punches.
No, it really doesn't.
The title alone is Elevated Mortgage Rates Strangle Housing Market Recovery.
Yeah, and strangle is a remarkably deliberate word choice for an economic analysis.
Yeah, you don't usually see that kind of dramatic language.
Exactly. Usually these reports use really passive, gentle verbs. Let's say the market moderates or softens.
Right, softens.
But choosing to say the market is being strangled, well, that indicates a very aggressive, very physical constraint on supply and demand.
Okay, let's unpack this. Our mission for you today is to figure out what exactly is doing the strangling.
Right.
We are going to explore those hidden forces keeping the mortgage market from collapsing entirely, and we're going to dive into the upcoming shifts at the Federal Reserve, which, by the way, operates completely differently than you might think.
Oh, totally differently.
And finally, we will break down a very specific financial and psychological trap that is keeping houses off the market and literally freezing people in place.
It's a perfect roadmap.
Awesome. So let's start with the baseline numbers. According to this Zillow report, we are lingering right near a 9-month high for mortgage rates.
Yeah, and breaking down those specific figures gives us a really clear picture of the borrowing environment right now.
Walk us through them.
So the standard 30-year fixed rate is sitting at 6.4%.
Okay.
The 15-year fixed, which, typically offers a discount for a faster payoff, is at 5.8%.
Wow.
And the 51 ARM is sitting at 6.42%.
Wow. Okay, so just to quickly clarify for anyone who maybe hasn't shopped for a mortgage recently, that 51 ARM, that's an adjustable rate mortgage where your interest rate is locked in for the first 5 years,
Yeah,
right?
That's right.
And then it adjusts every single year after that based on the broader market.
It's exactly
So
that.
basically, whether you are locking in for 3 decades or you're gambling on a 5-year window, you are staring down the barrel of a rate well over 6%.
You are. And the primary engine driving those rates upward right now is the broader bond market,
Okay.
which is reacting, quite frankly, violently to geopolitical tensions. When the global stage becomes volatile, the bond market shifts, and mortgage rates are just dragged along for the ride.
Okay, so I try to visualize this broader bond market pressure, and it feels a bit like a hot air balloon trying to lift off during a massive storm.
Oh, I like that analogy.
Right. So the geopolitical tensions are the storm winds, naturally pulling the balloon upward into the stratosphere.
Right, pushing rates up.
Exactly.
Mm-hmm.
But this is where the paradox comes in for me. If these global tensions are pushing the bond market up, and the bond market dictates mortgage rates, why aren't these rates at like 8 or 9%?
That is a million-dollar question.
Right. It feels like the balloon wants to fly higher, but there is some invisible tether yanking it back down to that 6.4% level.
Well, that invisible tether is very real, and the Zillow report points directly to who is holding the ropes.
Who is it?
It is Fannie Mae and Freddie Mac.
Oh, okay.
Yeah, they are functioning as an invisible cushion for the entire U.S. housing market right now.
Okay. Those are the government-sponsored enterprises. I think most people know the names Fannie and Freddie, but they might not really understand the mechanics.
Sure, it can be a bit opaque.
How exactly do two government-sponsored entities pull the ropes down on a global bond market? Like, how does that actually work?
So to understand their leverage, we really have to look at the life cycle of a mortgage.
Okay, take me through it.
When you go to your local bank and get a loan to buy a house, the bank rarely keeps that debt on their own books for 30 years.
Right, that would tie up all their money.
Exactly. They take your mortgage, bundle it together with thousands of other mortgages from all over the country, and create what is called a mortgage-backed security.
Well, mortgage-backed security.
Got it. Yeah. And then they sell that massive bundle of debt to investors on the open bond market.
Okay, making sure I follow the logic here. So the local bank sells the debt so they can get their cash back immediately,
Yes.
which allows them to turn around and offer a brand new mortgage to the next family walking through their doors.
Precisely. That is the essential mechanism of housing liquidity. But it only works if investors actually want to buy those mortgage-backed securities.
Oh, I see.
Right. Now, when global geopolitical tensions flare up, private investors get incredibly nervous.
Sure, they want safety.
Exactly. They look at these bundles of mortgages and decide the risk is just too high, so they demand a much higher return, a higher yield, to justify buying them.
Okay.
If investors demand a higher yield, your local bank has absolutely no choice but to raise the interest rate on the actual mortgage they offer you. That is the storm pulling the balloon up.
Wow. So the bank is essentially passing the bond market's anxiety directly to the home buyer in the form of a higher interest rate.
Yes, that is exactly what happens. And this is where Fannie Mae and Freddie Mac step in.
To grab the ropes.
Exactly. They have a specific mandate to keep the U.S. housing market liquid and functioning. So when private investors get nervous and step back, Fannie and Freddie step forward.
What do?
They actively buy up massive quantities of these mortgage-backed securities themselves.
Oh, I get it. Because they are guaranteeing the purchase, they are artificially inflating the demand for these securities.
Right.
And basic economics dictates that when demand for an asset spikes, the price goes up, and the yield, which is the interest rate, drops.
They are absorbing the market's anxiety.
Wow.
By constantly buying these securities with government backing, they ensure local banks can keep selling their debt, which keeps the interest rates offered to everyday homebuyers from absolutely skyrocketing.
It's so wild.
If Fannie Mae and Freddie Mac were not actively cushioning this market, doing the heavy lifting while private investors hide from geopolitical volatility, we would not be discussing a 6.4% rate today.
It would be so much worse.
It would be a vastly more painful number.
That reframes the entire conversation.
Yeah.
We're looking at a market that is already incredibly strained,
Yeah.
but it is actually operating on life support.
It really is.
But, I mean, even with Fannie and Freddie pulling the ropes down, they're really just treating the symptoms, right?
Yes, exactly.
They are manipulating the bond market to hide the fever.
Yes.
But the actual disease, the fire that is pushing that hot air balloon upward to begin with, is inflation.
Inflation is the foundational issue dictating everything else we have discussed so far.
Yeah.
The Zillow report highlights that inflation is not just lingering, it is a stubborn, entrenched concern right now.
And we all feel it.
We do. We are looking at elevated energy prices, and more concerningly, both the consumer price index and the producer price index came in significantly hotter than expected last month.
Okay, let's drill into that for a second. Everyone knows the consumer price index, or CPI. That's the sticker shock at the grocery store.
Right, what we pay at the register.
But the producer price index, the PPI, that is the less glamorous metric. Why is a hot PPI so alarming to economists?
Because the producer price index measures inflation at the wholesale level before the product ever reaches the consumer.
Okay, so further up the chain.
Exactly. Think about those elevated energy prices we mentioned. If you manufacture anything, whether it is lumber, appliances, or roofing materials, it takes electricity to run your factory and diesel fuel to run your distribution trucks.
Yeah, of course.
When energy costs spike, the cost to simply produce and move goods skyrockets. That is your hot PPI.
And manufacturers aren't just going to absorb those losses out of the goodness of their hearts.
No, absolutely not.
They pass those increased costs directly down the supply chain until it hits the retail shelf, which ultimately drives up the consumer price index.
Yeah.
It is a domino effect.
And that domino effect forces the Federal Reserve's hand.
Right, because they have to control inflation.
Exactly. The Fed's primary tool to fight that kind of entrenched inflation is to make borrowing money more expensive, which cools down business expansion and consumer spending.
Got it.
And that brings us to a massive focal point in the financial world right now, the upcoming Federal Open Market Committee meeting, the FOMC, on June 17th.
Oh, yeah. This is the room where the cost of borrowing money is literally decided.
It is.
And this particular meeting on June 17th is historic because it is the very first one for the brand new Fed chair, Kevin Warsh.
It's a huge moment.
So let's look at the board here. We have stubborn foundational inflation. We have mortgage rates requiring artificial government intervention just to stay at a 9-month high. And we have a new leader stepping into the most powerful economic seat in the world.
Quite the setup.
It really is.
Yeah.
Usually when a new CEO steps into a struggling corporation, they want to make an immediate impact. They want to shake up the strategy, pivot the company line, and prove they're in charge. Is Kevin Warsh going to walk into the Fed on June 17th, flip the table, and drastically alter the path of interest rates to make a point?
What's fascinating here is how entirely divorced the culture of central banking is from the culture of corporate America.
Really? How so?
The instinct to act like a maverick CEO simply does not exist at the Federal Reserve. Fed decisions are deeply inherently built on consensus among a committee of regional presidents and governors.
Okay, so we shouldn't expect a dramatic debut. He isn't going to just, slash rates to stimulate the housing market on his first day.
No, definitely not. I mean, a new chair certainly brings a different communication style and perhaps a different philosophical approach to long-term economic strategy.
Right.
But they do not operate by decree. Because of the hot inflation data we just outlined, the energy costs feeding the producer prices, which feed the consumer prices.
Right, the dominoes.
Exactly. Because of that, the baseline expectation from Zillow Research and the broader financial community is that the Fed will hold rates completely steady. They are going to wait.
Okay, but wait. If the baseline expectation is just a holding pattern, why is everyone on Wall Street obsessing over this June 17th meeting?
That is a great question.
Right. If the actual interest rate isn't going to change, where is the actionable information?
Well, the information isn't in the rate decision itself. It is in a supplementary document they released called the Summary of Economic Projections, often referred to as the dot plot.
The dot plot. Okay, I've seen screenshots of this on financial news.
Yeah, it's famous.
It literally just looks like a scatter plot graph with a bunch of blue dots on it.
Yeah.
Why is this piece of paper the most dramatic part of the meeting?
Because the market operates on expectations of the future, not just the reality of the present.
Okay.
The dot plot is a chart where every single member of the Federal Reserve Committee places a dot indicating exactly where they believe interest rates should be at the end of this year, next year, and the year after that.
Oh, wow.
It is the closest thing to a financial crystal ball that exists.
So even if they don't change rates today, those dots tell the bond market what they are planning to do tomorrow.
Exactly. And the bond market reacts instantly.
Really? Just to a projection?
Oh, absolutely. Historically, there have been times when the Fed held rates perfectly steady, but the dot plot revealed that committee members were secretly planning to keep rates higher for much longer than the public anticipated.
And what happened?
Within seconds of that document being published, bond yields spiked and mortgage rates shot up, entirely based on the projection of future pain.
That is wild.
But conversely, if Kevin Warsh and his committee place their dots lower, hinting at cuts coming in the fall, bond investors will immediately price in that optimism, and mortgage rates could actually soften before the Fed takes a single official action.
Wow. So we have a macroeconomy that is essentially holding its breath, waiting for a scatter plot graph to tell us the future.
That's a great way to put it.
The balloon is fighting the storm. Fannie and Freddie are exhausted, pulling the ropes down, and the new Fed chair is just holding steady.
Waiting for the dots.
Right. But, we have to bring this altitude down. We need to look at how this waiting game is physically manifesting on the ground.
We do.
Because these aren't just abstract economic theories. This holding pattern is happening on neighborhood streets right now.
Yeah, and the physical manifestation is where the Zillow report provides the most vital insight. Because heading into 2026, there was genuine, data-driven optimism on the ground.
I remember that feeling.
Yeah.
It seemed like the worst of the post-pandemic housing gridlock was finally breaking apart.
The optimism was entirely justified. Earlier this year, affordability had tangibly improved.
Really?
Yeah. Income growth was actually starting to outpace home value appreciation, meaning people's paychecks were growing faster than housing prices for the first time in a while.
That's huge.
And crucially, mortgage rates had drifted down closer to a manageable 6%.
Okay, yeah. It felt like the window of opportunity was cracking open just a little bit for everyday buyers.
It did. But then, as the report meticulously tracks, those bond market pressures forced rates to spike back up to the current 6.4%.
Right, the storm winds picked up again.
Exactly. And on paper, a jump of 0.4% might sound trivial. But in the real world, that shift was violent enough to severely erode all of those recent affordability improvements.
So what was the fallout?
The reaction was immediate. May home sales and new listings both plummeted compared to the previous year.
So what does this all mean?
Well, it changes the whole dynamic.
I mean, I completely understand why buyers step back.
Yeah.
You run the mortgage calculator at 6% and you can afford the monthly payment.
Right.
You run it again at 6.4% and suddenly you are stretched way too thin, so you pause your search.
Makes total sense.
But why did new listings fall? Like, why did the people who already own homes suddenly stop trying to sell them?
You've hit on the central thesis of Karaneng's analysis. The defining feature of this market isn't just a lack of buyer demand. It is a complete strangulation of supply driven by the rate lock constraint.
The rate lock. Okay, this is the financial trap.
Yes, it is.
Let me put it this way for you, the listener. Imagine you refinanced your house a few years ago during the rock bottom environment.
Back when rates were nothing.
Right. You were sitting on a 3% or 4% mortgage. Your monthly payment is incredibly comfortable.
Yep.
Now imagine you want to move across town. If you list your house today, you give up that 3% mortgage, and you're forced to finance your new home at 6.4%.
A tough pill to swallow.
Trading your current rate for today's rate isn't just a mild inconvenience. It is mathematically equivalent to taking on a second car payment every single month, just for the privilege of moving to a house that might not even be an upgrade.
The math is brutal. It really is. For an average-priced home, the difference between a 3% rate and a 6.4% rate translates to hundreds, sometimes over $1,000 more a month in pure interest.
Wow.
When homeowners stare at that reality, the vast majority make the perfectly rational economic decision to stay exactly where they are.
I mean, you would have to be incredibly desperate to voluntarily surrender that cheap debt.
And the Zillow research proves this constraint is absolute. The data shows that home sales have only rebounded in local markets where supply has actively surged.
Right.
It highlights a fundamental law of physics in real estate. Buyers literally cannot purchase homes that do not exist on the market.
Yeah, you cannot buy invisible inventory. If the houses aren't listed, the sales data flatlines.
People are actively delaying their lives, even if a family is growing and needs an extra bedroom, even if someone wants to downsize for retirement or relocate to a better school district.
They just can't do it.
The financial penalty of the rate lock overrides their personal desires. They bunker down.
I want you to really think about this for a second. Think about the streets in your own neighborhood.
Yeah, what stands out to you when you walk around your block right now?
A few years ago, there was a natural, fluid rhythm to most communities. A for sale sign pops up, a moving truck arrives a few weeks later, a new family moves in, renovations happen. It was a cycle.
A healthy cycle.
Are you seeing fewer of those signs now? Do you feel geographically trapped by the terms of your own mortgage?
We have transitioned from housing as a fluid utility to housing as a fortress. People are barricading themselves behind their historic interest rates.
Man, that is bleak.
And this creates a vicious, self-sustaining cycle. Because people refuse to sell, there is virtually no supply for the buyers who are willing to brave the 6.4% rates.
And what does that do to prices?
That desperate competition for a tiny handful of available homes keeps property prices artificially inflated. High prices, combined with high rates, further erode affordability, which makes even more people refuse to move.
It is the literal definition of the word strangle. The market is choking on its own lack of inventory. It is genuinely incredible how a producer price index number, or a dot on a scatterplot graph in a Federal Reserve boardroom, can so directly dictate whether or not a family decides to put a sign in their front yard.
Everything is connected.
It really is. Let's pull all these threads together to lock in the big picture.
Good idea.
We started by realizing that the 6.4% rate we are all stressed about is actually being artificially cushioned.
Yes.
Fannie Mae and Freddie Mac are absorbing the bond market's anxiety by buying up mortgage-backed securities, keeping rates from flying into catastrophic territory.
They are providing the essential liquidity that prevents a total market freeze.
Right. From there, we looked at the underlying disease. Entrenched inflation, driven by energy costs and high wholesale prices.
The hot PPI.
Exactly. That inflation has put the Federal Reserve in a holding pattern. We have a new Fed chair, Kevin Warsh, stepping into a room built on consensus.
No table flipping.
He isn't going to flip the table. But the entire financial world is waiting with bated breath for the dot plot, the summary of economic projections, to give us a hint at where borrowing costs are headed next year.
The dot plot acts as the catalyst for the bond market's next move, long before any official rate changes occur.
And finally, we brought it all the way down to your neighborhood. We saw how the optimism of early 2026 evaporated when rates bumped back up, triggering the rate lock trap.
The fortress.
Sellers are refusing to surrender their cheap 3% mortgages, completely strangling the supply of available homes and leaving the market paralyzed.
It is a comprehensive anatomy of a stalemate.
It really is.
But before we conclude, I want to leave you with a final, lingering concept to mull over. Something that builds directly on the Zillow Report's finding that sales are only rebounding in markets where new supply is actively surging.
Okay, I'm intrigued. Where does this lead us?
If homeowners increasingly refuse to sell because they are financially trapped by their old mortgage rates, we have to ask, are we heading toward a permanently fractured map of the country?
A fractured map. What do you mean?
Well, consider a near future where certain cities, specifically the ones with massive swaths of available land and free-flowing new construction, continue to grow.
Right, because they can just build more houses.
Exactly. They attract new talent and evolve dynamically because there is actual inventory to buy. But meanwhile, older, established neighborhoods in dense cities where there is no room to build new homes become completely frozen in amber.
Wow. That is a fascinating, slightly dystopian thought.
Imagine a society where millions of people are quite literally paralyzed from moving across the country to take a better job, or relocating to be closer to aging parents simply because they cannot afford the penalty of abandoning their historic mortgage rate.
That is just wild to think about.
We could be looking at an entirely new type of geographic and economic divide, one dictated not by your profession or your income, but entirely by the year you happen to finance your house.
A permanently fractured housing map. An economy where human mobility is dictated by a financial trap.
It's a real possibility.
That is a heavy but incredibly necessary layer of this to consider. It brings us right back to the feeling of that waiting room. We're all sitting here watching the economic data, waiting for the Fed's dot plot, waiting to see if this heavily cushioned hot air balloon is ever going to find a safe place to land so normal people can just get on with their lives.
We're all just waiting.
We really are. Thank you so much for joining us on this custom deep dive today. Remember, the absolute best way to navigate a market that feels completely stuck is to be the person in the room who actually understands the mechanisms of why it is stuck. Keep looking closely at the data, keep an eye on your own neighborhood, and stay curious.